Well, look, Europe's been lagging in the recovery vis-a-vis the US and China, but now it's having a sort of 6-month period through the middle of 21 where it's outperforming, partly because it opened up a bit later and you have that reopening boost, but also because it's more resilient to Delta with the higher levels of vax that it's got. So we're quite confident about European growth. It looks like we're past the peak now. If you look at the PMIs and the ZEW and the IFOs and so on, we are decelerating, but we think very strong growth still continuing in the third and fourth quarters, getting through the pre-pandemic level in the fourth quarter, and then settling next year at a level of growth that's going to be a bit above pre-pandemic levels because of that extra boost we're getting from the recovery fund. So really, this has been a very bank-friendly crisis, despite the depth of the contraction. That policy support, the guarantees, the liquidity has protected banks, and the support for the wider economy has meant that you haven't had a rise in unemployment and bankruptcies, the sorts of things that drive NPLs up. So banks are actually exiting with stronger balance sheets than expected, and perhaps than pre-crisis, given the lack of distributions that have happened, and face a better growth environment than pre-crisis. So quite positive on the outlook for the banking sector from a macro point of view.
Certainly sounds so. And I know as an economist, it's never easy to give the counterfactual, but how do you think European banks would have done if there hadn't been this much government support in place?
It was absolutely crucial because you saw in March 20, before we had the support packages put in place, that the blowout in spreads and the rise in yields, it would have been hard enough for banks in the core of Europe to fund themselves and to avoid having to contract and call in loans. It would have been almost impossible for banks in the periphery who have weaker balance sheets and would face much, much higher funding costs. So I think that March 2020, it's a sort of, if you go down that road of no broad policy support, you can see a very difficult sovereign debt crisis and banking crisis unfolding in Europe. But the lesson's been learnt. It's very unlikely because after the experience, after GFC and the sovereign debt crisis, European policymakers stepped up to the plate and provided massive support in a timely way and prevented that. And it looks to us like they will continue providing that support. The fiscal rules remain suspended in 22, so fiscal policy should remain supportive. We think there'll be an SPD-led government in Germany, which implies more gradual fiscal consolidation, more openness to integration on financial matters, banking union, capital markets union. That should be supportive. Now, the ECB is quite divided. There's a big debate about whether they'll taper or hold tomorrow. We think hold, but not with high conviction. But in the end, we think because inflation in Europe in 22 and 23 and core inflation now, it's still well below target. We think they'll continue providing accommodation. So that story of easy policy continuing for longer in Europe should, we think, combined with the recovery fund, which is very targeted on very high quality, high growth multiplier investment, should support stronger growth in Europe going forward.
When it comes to the key support that European policymakers have provided over the last year and a half, of course, the labor market comes right to center of mind. And we spoke a lot at the beginning of the crisis about the different approaches being taken by the U.S. and Europe when it came to supporting the labor market, with the U.S. opting to expand unemployment benefits, but Europe opting much more for these furlough schemes. Now, given where we are in the pandemic with restrictions easing and life getting back to normal, do you think the European approach has actually served the European economy, perhaps even more so than what we've seen out of the U.S.?
Well, the rise in unemployment has been much more modest, right? And we're only 50 basis points now above the pre-pandemic level of unemployment. There may be a small rise as furlough winds down and some people get laid off, but it's going to be a much more modest increase than in the US. The US has a super dynamic labor market, which is very good at matching. And so it got people back into jobs very quickly. That's not so much the case in Europe. So I think that while it may have worked reasonably well in the States, it would have been a big risk to pay unemployment insurance rather than supporting the job as they did in Europe. So it's certainly appropriate for Europe. And I'm afraid we don't know the answer about which was better, and there'll be a host of PhDs to try and answer that in future, but it certainly has worked very well for Europe.